Um, so I've seen a lot of this business, how money is made. I've seen many people come in and become millionaires. I've seen people come in and lose the initial margin money they put up. I've seen a lot of mistakes made, and I've seen a lot of people grow very wealthy, actually, starting with almost nothing. And that's what makes this such an exciting field to be in. But I want to start at the very beginning, and I also want to mention that if you have any questions on the material as you watch it on the audio tape, feel free to go to the manual where I've covered in great detail some of the things I'm talking about here. The place really to start is leverage, because this is what got me interested in the futures market when I was still in college, really. I read a book by a doctor in Canada called Morton Schulman, who wrote a book called, I think, Anybody Can Make a Million. And he talked about leverage, and that's what I want to begin talking about here. Leverage, simply put, means you put down a little bit of money, and you control an asset worth a lot more. As a result, you have what's known as the multiplier effect. Now, to understand this concept, you have to take the notion of an ordinary worker. You take a 16-year-old high school student who's working at McDonald's, flipping burgers. He is making $5 an hour because at that stage in his life, that's what the market thinks he can get based on the minimum wage. And so he doesn't have a multiplier effect. In other words, for him to work 1 hour, he'll make $5. Now, go to the other extreme, and you have a highly paid surgeon who's gone all through college and medical school, and he may make several $100s an hour, or even perhaps $1,000 an hour. But the point is, the surgeon, like the employee at McDonald's, has only so much time in his day. Even though he's making a lot more as a surgeon, he still can only work so many hours, and he tries to maximize his hours in order to maximize his profit as a doctor. And for that reason, he'll have somebody come in and take your blood pressure, for instance. Another person will lead you into the room where he'll come in and then see you, because his time is very valuable. Now, the point I'm trying to make here is that the surgeon is very similar to the student working at McDonald's, in the sense that he has only so much time. He doesn't have the ability to multiply the number of hours he has in a day. And that leads to the whole notion of leverage, because with leverage, what you're doing is you're multiplying the power of your dollars. In other words, $5, if it's 5% margin you put up, controls an asset worth $100. So if you get a 5% increase in the value of the asset to $105, you've now doubled your money. You've made 100% on the 5. And that's really how leverage works. Now, there's a downside to that. We're going to get into that in a minute, which is essentially if you were to lose 5% and it were to go to $95 from 100, now you've lost 100% of what you put up. So it goes both ways. So leverage, in short, means you're using a relatively small amount of money to control an asset worth many times as much. And in the futures market, as you will see as we get into this tape, that's precisely what you do. You put up a small amount of money and you control an asset worth many times as much. And it's important to understand this concept because so many fortunes are based on this. In real estate, this is almost always the way that large fortunes are made, on leverage. You borrow the money from the bank, essentially, and you pay them interest on that money. And then if the value of the real estate goes up, you participate in the full amount. Well, it's the same way in the futures market. So in short, leverage multiplies your efforts. It's a little bit like instead of having just yourself earning money, you've got a lot of workers out there, and the workers are your dollars that are working for you. Just to make sure that you understand this concept, because it's so important to the notion of futures trading. Take the case of a $100,000 house. If you put up 10% of the value of the house, it goes to $110,000 in value. You've now made 100% on your money. If you're not leveraged and you put up $100,000 to buy that house, you buy it for cash, and it goes to $110,000, now you've made exactly 10% of your money. And that's the difference between being leveraged and not leveraged. The leveraged person makes 100% by putting up $10,000. The unleveraged person makes 10% by putting up the full value of the house. To take another example, you take an asset worth $1 million. It's not unusual these days for the stock market to move 1 or 2 or even 3% in a day. 1/2 of 1% of $1 million is $5,000. 1/4 of 1% is $2,500. And it's not unusual in the futures market, certainly, to get a small move like that so that it translates into those kind of profits even within one day. That's the good news. Now, the bad news is it's a double-edged sword. If you put up margin money and the market goes against you a small percentage, you lose a larger part of that margin. So to summarize on leverage here, leverage is the key to building wealth. It's not without its downside risks. But most importantly, as you'll see, when we get into the nuts and bolts of trading futures, you'll see that you can successfully manage the risk. And that really is the key. Now, how do futures and options work? We know that they're highly leveraged contracts. Unlike the stock market, where you either put up 100% to buy a stock or you buy it on margin, in the futures market, the concept of margin is a little bit different. When you purchase a stock on 50% margin, in other words, you put up $5,000 to buy $10,000 worth of stock, you actually borrow the other $5,000 and you have to pay interest on that money. In the futures market, it's nothing more than what's called a good faith deposit. By putting up margin, what you're saying is, I am good for any losses on this position, and here's my money in this account to show you that I am good for it. So what they are legally binding agreements made between a buyer and seller on a centralized trading exchange. There's always a buyer and there's always a seller when a contract is created. They're known as futures because they pertain to some future date. For instance, you may have July soybeans, for instance, and you may buy them in April, and that's for delivery in July. And then when it gets into July, you offset the contract, and I'll get into that in a moment, how you do that, and you may what's called roll into the November soybeans. Now, those beans are for delivery in November. As a speculator, you don't ever participate in the actual underlying commodity, depending on what it is: hogs, pork bellies, cattle, corn, wheat, treasury bonds, stock indexes, or whatever. All you do is you speculate. You take on the risk that the users of the underlying futures want to offset. And we'll get into that in a minute, how that actually takes place. You need to know that there's some 30 to 40 contracts traded around the world, and there's more all the time. They're traded on centralized exchanges. In this country, they're primarily in Chicago and New York, though there are futures exchanges in Kansas City, Minneapolis, and in Canada, in London, and really around the world. In Asia, there's futures exchanges as well. Now, they break down into certain categories. There's the so-called agricultural commodities, and people in the Midwest are very familiar with these: the corn, oats, soybeans, wheat, livestock, frozen pork bellies. In the early 70s, they introduced the concept of futures contracts on foreign currencies: Japanese yen, Swiss francs, German marks, British pounds are among the the most widely traded of these currencies, but they also have them on the Mexican peso, the Canadian dollar, and even on the Russian ruble now. There are futures contracts in financial instruments, such as Eurodollars, Treasury bills, Treasury notes, and Treasury bonds, which happens to be one of the most widely traded futures contracts in the world. And then, of course, in the early 80s, they introduced the concept of stock index futures, and those are futures contracts based on a cash index generated on a basket of stocks, such as the S&P 500, the Dow Jones averages. Also, there's futures contracts on precious metals, which are well known, silver, gold, platinum, for instance. So there's a wide variety of futures contracts traded around the world, and primarily in the United States, where Chicago is the leading center for futures trading in the whole world. Now, the features of these are that they're standardized. So if you buy one contract for delivery in a given month, every other contract for delivery in that month is identical. And because they're standardized, it means you can offset or buy or sell another contract of the same futures and get out of the position you're in. It's a liquid market. And during trading hours, it's very easy to get in and out of these markets. Also, because they're standardized, they all have the same point value for the given commodity. In other words, if you take a grain like soybeans and you get a 1-cent move, because of the size of the contract is 5,000 bushels, it translates into $50 a penny. So if you get a 1-penny move in soybeans from, say, 621 to 622, you just made $50 on one contract. Now, the different contracts for the different commodities are different. As a result, the tick, what's called the tick value, will be different, the minimum amount each can move. And like I said before, when we're talking about leverage, they're all bought and sold on margin. So all you do is you put up a good faith amount. The positive aspect of this is it creates enormous leverage, which works in your favor if the position is profitable. But put simply, a small amount of money controls an asset worth many, many times as much.